the fact that they're not going to have the jobs data for that December meeting exploded odds. So now we're only at like a 29% odd of a cut in December.
The forward inflation is actually rolling over as nominal yields are rising. This is causing, I think, the liquidity suck and everyone's selling the riskier parts of the market. But it really hinges on Fed forward guidance, because as soon as they take the punch bowl away, quickly these things can reverse.
The cuts need to happen at some point, and they're going to happen at some point. So basically it allows them to get more juice in 2026. They're going to have to spend like bats out of hell. That is the formula, and it's going to have to happen. Otherwise, it will be an absolute bloodbath.
This episode is brought to you by Grayscale, your trusted gateway to more than 30 different crypto investment products. You'll hear more about them later in the episode. Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed. All right, everybody, welcome back to another Roundup edition of Forward Guidance, and we are recording about 10 minutes after NVIDIA earnings, and it's looking like Jensen Huang has seen his shadow again. Therefore, 6 more weeks of AI CapEx Ponzi have been promised. We have... He has seen a shadow, therefore the Ponzi lives again for another 6 weeks. Thank you. I'm
great framing.
Okay, so EPS adjusted $1.30, estimates at $1.25, revenue $57 billion, estimates $55 billion, and then in terms of guidance, looking at $65 billion revenue, whereas guidance estimate $62. Gross margin estimate was 74%, guidance for 75%. So boom, we got the double beat on the actual earnings and the beats on guidance for next quarter. The AI Ponzi lives again. What's your guys' read?
I have no actual insightful read on this other than a funny comment that, we always talk about how the whole world and everybody's retirement and, lives on NVIDIA's stock price. And it's kind of funny how it's jokes, but it's like a stereotype. There's a reason it fits, because it's true. And you'll like hear people in public talking about NVIDIA earnings that should absolutely not be about it.
It's literally Groundhog Day for the market. We all show up and just see whether they saw their shadow or not.
And I can't help but think, like, if you're Bessent and Trump, what is like one of the lowest, and this is like complete speculation, but what are the lowest effort risk reward type of like manipulative things you could do is just in the same way that Elon never really, I guess he got a little in trouble for the 420 buyout thing. They should have the auto pen giving Jensen a auto future pardon, so he can just like every earnings call just make up increasingly ridiculous numbers, so then the market just it's next forward 5 years is $5 trillion of revenue, and then it's like that's where we're getting into, just monopoly money numbers at this point.
That would be insane.
It's kind of wild. My only read is the implied move was like 7%. It's up 3.5%. Post market, I think you're going to get, this is one of those event risk things that rolls off. Everyone was worried about it, could have cracked, but now, the VIX was kind of inverted. So the front month VIX was bid up relative to, 3-month VIX. And theoretically, we'll see tomorrow if that kind of rolls off, meaning everyone's protection that they bought for downside just in case things got ugly should roll off. But I don't know. I don't know if this heals everything, because there are parts of the economy we can talk about that really aren't. I think there's 2 economies, and I did a big long Twitter post about it today. So, we just know that this part of the economy that's centralized and is got a massive government kind of backing is still healthy, or at least on the surface, a lot of the CapEx cycle still.
Yeah.
So.
Yeah, I think overall, despite the positive news, like what we talked about last week in terms of how this funding of the AI CapEx is evolving is still super relevant. And just really want to hit the nail on the head on a couple charts here. If you can see this in action. So this is bond issuance by big AI tech companies. and you can just see the absolute change here. It bears repeating because I think it's really important, because as we move forward into this, the marginal driver of sentiment and risk around these AI companies is going to be led by credit investors now, not equity investors, and they just have a completely different risk profile. Like, if you're buying long duration growth stocks, you're okay with betting on a vision that comes forth in 10 years, maybe. Whereas if you're a credit investor, or you're the one funding these bond issuances, you have a very different risk profile, and you want to see some tangible impact pretty soon. So you can see, like, the reason this is happening now is this is just a forecast of how much of this CapEx is going to be done by free cash flow, operating cash flow, over the next couple of years. And you can see, starting next year, we're going to really quickly get to the point where almost 80% of their free cash flow is going to be funding the AI CapEx. So that's why you're seeing this pivot towards more bond issuance now. And I still think, like, I don't think it's a bubble popping type of situation, but I think it's a recalibration of how people should look at the risk parameters of this AI CapEx build out, because it's just a different subset of people. I don't know if you guys have any thoughts on that.
There was actually a great snippet from the information. I'm going to read this, so if everyone gets pissed at me, but slide 60. This is from the publication, the information. They basically said the demand for Meta's Beignet data center, I don't know how you say that, in Louisiana, it was so strong for the bonds that Morgan Stanley ginned up the structure, was able to sell $27.3 billion of bonds to a select few big investors. A higher yield helped. The only grumbling I heard about the deal came from people who didn't get a piece of it. What's become clear is that a lot of capital can be brought to deals backed by trillion-dollar companies. And then if you go further, it says Amazon this week sold 15 billion in bonds in an offering upsized from 12 billion due to high demand. So there is like massive demand on the debt side from these things, which just goes to show you like how much the yield from pension funds and endowments and insurance companies, like they need this stuff. And if you're a AAA rated company with cash flow, it's going to get hoovered.
Yeah. The funds of demand.
The funny thing about this is, well, it's not funny, but is they historically, the Mag 7 trillions of dollars in market cap have been unlevered and not, or are very low levered and not needed to be so ridiculous, such large users of the debt markets. So when you kind of read that snippet, Tyler, it's like it probably isn't good. It's probably another blow to middle business, small businesses, in a further crowding out of another market for them, which is financing. As basically, you can see in the stock market, everybody's thrown everything out the window for Mag 7 stocks, and this is just the debt form of that paper, and makes you wonder if the same thing is going to happen before. And that being the final straw, because like credit financing is the backbone of the economy and growth and Main Street. So maybe there's still.
I think to your point on that is like a lot of the smaller companies that need debt financing are getting boxed out now because, why would you buy, if there's a lot of supply from Amazon, why would you buy, XYZ company that's a little bit levered and a little bit, less in secular growth. This is just. It's the same story of the K-shaped economy where the big get bigger and the centralized lever up, and then you've got to bail out. It's just the system just keeps centralizing.
And that's the thing is we sound the same every week, but it's just more data points that get more crazy because effectively NVIDIA is a too big to fail institution. When we put all this together, the concentration risk, I was calling it last year a national security risk, but what is that? In other words, too big to fail. So as a credit investor, you're buying
government backed debt.
Exactly. So why would you go buy the random manufacturer or whatever? And if this crowding out starts happening in the debt markets,
well, what's there going to be left? So this, I just want to run a couple macro charts on that. So check this out. So this is slide 51. This is probably my favorite chart in all of macro. This is the 2-year nominal yield, versus the 2-year break-even inflation forward-looking. So nominal yield minus inflation, just it basically shows real rates. So when the ratio of the two is the second chart below, and you can see as it rises, that means real rates are rising. Means liquidity is getting sucked out of the system. Dollars are harder to come by, and so it's kind of interesting is the forward inflation is actually rolling over as nominal yields are actually rising. And this is causing, I think, the liquidity suck and everyone's selling, the riskier parts of the market, right? But it's fascinating. Like all of the big growth sectors that we know, and crypto included, have just gotten walloped off that little rise in nominal or in real rates. And that's sort of why I'm in this purgatory where this is really just, I call it the Weimar Ponzi scheme. 10 minutes in, I did say Ponzi this time. But it really hinges on Fed forward guidance, because like as soon as they take the punch bowl away, how quickly these things can reverse.
I think that'd be a good way to contrast against, to your point, this reversal has been Fed driven. We've seen a huge pivot from them over, and we just got the Fed minutes today, which shows that this hawkish pivot has been in the works for a bit. And it's probably a good moment to criticize just how insane this communication style is of forward guidance, that literally their last meeting over a month ago now, they were talking about the fact that they don't see a case for cuts in December, but it only took them until like a week ago to be actually like price that out of the market. So in the meantime, you have this really weird whipsaw effect where we haven't had any government data. And then you just have these Fed folks coming out of nowhere, be like, actually, I don't want to cut in December, even though the last thing that we know about was them saying, oh yeah, we're on autopilot for cuts for the next little while. But then, lo and behold, that whole last meeting in the minutes, they were talking about this. It's just they didn't publicize it until like today. If you're thinking about crypto investing but don't want to open a new account or manage keys and wallets, check out Grayscale. Grayscale has been offering trusted crypto investment products for over a decade, with 30 and plus counting, including single asset funds like Bitcoin and Ethereum, diversified portfolios, and thematic exposure to the broader digital asset space. Many of the products are available directly through your brokerage or IRA, just like a stock or ETF. Investing involves risks, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
And the weirdest part is this is coming at a time when there's some problems in credit markets. Like there's the tricolor stuff, there's subprime auto. Then this is one of our guys who's in the Telegram chat, but he's talking about, have you guys watched the Blue Owl private equity redemption thing at all, or not really?
No.
Okay, so I'll just read this. So one of Blue Owl's private credit funds allows for 5% redemptions per quarter, but in quarter 3, they had 6% redemptions requested. So they had announced they'd freeze redemptions and merge it with a publicly traded business development company and give shares to fund the unit holders at NAV. So instead of selling the assets because they couldn't, because they're private debt, to provide exit liquidity, unit holders could exit by selling shares of the public business development company in the open market, except they received the shares at NAV, but the stock immediately traded down 20% below the NAV. So they had an instant haircut from the business development company that they created. But then today they announced that they're canceling the merger and redemptions of the fund are still frozen. So there's weird stuff happening in credit markets, which is making me, less bearish. I'm bullish. And it's like, I want to see a couple more cards come out of the deck. And on top of that, the private equity guys, the PSP ETF is actually kind of rolling over here. It hasn't really gotten a bid. So there's some funky stuff going on in different pockets of the market.
I think what's tough too is that those funky things are happening. They're in also, just a really funky time. Like we've had the shutdown, and now we just learned today that, let's go through a couple charts here in terms of this update on where we're going to actually get some of this economic data. So the BLS came out today and said that they will not publish the full October employment report, only the establishment survey, which will accompany the November release due on the 5th of December. BLS also confirms the November jobs report will be published on December 16th. That's after the final FOMC meeting of the year. And it's really interesting that I think we could all assume that this data is not going to be great, but just the fact that it's absent sent a really hawkish cascade into the market. So you can see the probability of a Fed rate cut in December based off this announcement. The fact that they're not going to have the jobs data for that December meeting exploded odds. So now we're only at like a 29% odd of a cut in December based off that. And that's just, man, like we are so in the dark right now on what's going on. Like, and all our good signals, like the Atlanta Fed GDP now cast, which has become really popular, is completely broken right now. It's saying 4.1% growth because none of the useful data points are actually being attributed to it. It's just random survey data like ISMs and stuff, but the core important parts are just not going into it. So like we are just, on one side, I understand the Fed being cautious and not wanting to cut in December just because we have no idea what's going on. But on the other side, like that also creates some pretty big tail risks here.
Yeah, this goes to sort of what the point I was making last week, which is it looks just like a concerted effort to deflate the bubble a little bit because all of this stuff is producible. Like I know the government systems are probably archaic and crappy, but at the end of the day, these are all human choices being made, and there's a reason. There's some reason behind it, and my guess would be what this allows for is if you're a Trump admin investing, you're like, well, what does another month or 6 weeks of into year end, how does that really change with the Fed cut? Okay, markets stay a little bit more supported, but this way they can blame it on Powell and the Fed if the markets go kaput because they don't cut, and they basically get more. The cuts need to happen at some point, like they're going to happen at some point. And so basically it allows them to get more juice in 2026. Presumably that's better for markets. And we know, I mean, it's 6 weeks left of the year, 2026 rolls. Re-election is all that matters. And it's an uphill battle. Like at this rate, it's going to be a very steep climb for Republicans to control the midterms. And so in a sense, they might just be saying, well, let's extend it. We already extended it with the government shutdown. Why not extend it a little more, save more juice for next year? And then we can blame it on Powell if the S&P goes down another 5 or 10% on further growth scares. It's kind of how I view it, to be honest.
I think for that reason is why I think they're going to Hail Mary it on the $2,000 tariff dividends. Like, yes, you need congressional approval, but man, like if Trump pushes the Republicans to put this to a House vote, and if you're up for re-election in the midterms and you vote no on the perception of like this is quote unquote tariff revenue from another country paying for it, like that's the narrative that they're trying to push. And it's like, all right, if you're saying no to free money to your constituents when there's an affordability crisis, like you're not going to get reelected. So my read is that they're going to push this to a vote, and it's going to be basically you can write your own destiny as a congressperson. And I think that's going to be the move here. And I think that's why they're targeting mid-2026 to unleash those. And like that is just 1,000 times more potent than QE. Like I really think people are missing the mark on what are the drivers here. It's not, the acronym factory of the Fed balance sheet. I think it's more so these type of things.
Well, just to push back a little, that spending matters, but then they have to finance it. And if there's already liquidity issues, then it works until the Fed stops financing it. And right now, with no RRP and them extending duration of the balance sheet, they're sort of choosing not to. But we know with Trump's Fed pick that's likely to change. But I agree. I mean, so that points, there's possibility for like a real rate scare prior to the Fed action to expand balance sheet finance it happening. But yeah, if you just read the tea leaves here and extrapolate Dems results in these elections, continued populism and Trump approval ratings for Trump across all these facets, all of those things say that it's going to be a very difficult midterm for Republicans. Yeah, things can change, but they're going to have to spend like bats out of hell. I mean, there's just no, like, that is the formula, and it's going to have to happen. Otherwise it will be an absolute bloodbath. And I'm working on this kind of thought piece that's, for the most part, Bessent's navigated this year well, but next year it's a test. I mean, you gotta.
Well, did you see Trump calling out Scott today and at like a Saudi Arabia conference or something? And he's like, Scott, if you can't lower the rates, I'm gonna fire your ass. It's like, whoa.
That is so. Yeah. It's so weird when these things come to me sometimes. But I'm stewing on it. I give write a longer piece on it. But I've been thinking, I was like, man, I think Bessent's handled this year well. But like in the same vein of the possibility I mentioned last week of this potential Mag 7 CEO love affair, rug pull that I could see when populism rises next year. The other side of that is Bessent, because they need government spending up and inflation down. They need, oil prices down, but they don't want geopolitical war with Venezuela. And if you start something, they need to, and if you start some Venezuela, more geopolitical risk and, is reflexive because, other adversaries might take advantage of that. Like all of these things that it's like Biden kicked the can for Trump. And then, there's like an element of Trump and then everybody's just kicking the can. And next year is like, I don't know how they thread this needle. And really the only way is like balance sheet expansion where you can then finance and to what I was saying last week is they have to cadence it in a way where you get all the juice benefits from like April to November. And then like the wrath of the inflation and hawkish Fed and things come after. But it'll be interesting.
Yeah.
But you know what? I got to say what Bessent's been going around doing interviews saying, Wall Street's done so well. It's time for Main Street. And like, I don't know what he's done there. So I don't know. He talks a big game in terms of that stuff in a lot of the interviews as like, a man for the people. And I think he's done good jobs in managing a lot of the intricacies of Treasury, but there's been nothing on that. And clearly I don't know. I watch that middle income basket keeps rolling over. XRT's going lower. I don't know how they solve that. And
I think they need to cut rates a lot, and I think they need to offset that with a hawkish balance sheet. I've been pretty tapped in on just this contrast right now between when you look at Bowman, Waller, and Moran, the three that probably speak most closely to what Bessent and Trump are thinking about. They're all super dovish on Fed fund cut and hawkish on the balance sheet. And then today we got in the Fed minutes this update of overall most participants favored a long run composition of the SOMA portfolio that matched the composition of Treasury securities outstanding. So we talked about this a few months ago. There were some hints at it in the minutes that they're beginning to deliberate on this, but I'll just walk through a couple of charts to explain what this actually means. So here we have the federal balance sheet weighted average maturity. So 8.96 years is the weighted average maturity of it. So the Fed owns a lot of long duration assets. On the other side of the equation, you have the Treasury debt, which is at 5.86 years. So less duration. So this is the key theme. The Treasury is issuing more bills, so their duration is much lower. Then on the other side of things, the Fed has much longer duration. So what's been going on is that they have been the net absorber of duration from the markets over the past few years. And what they're saying in that note is that they want those two durations to match. They want to lower the duration of the Fed balance sheet from 8.96 years to match the Treasury at 5.86 years. So you can see this in action. This is looking at the Fed balance sheet. So you can see the amount of long duration Treasury, so 10 years and above, that they've been amassing originally through QE, and then just through the way that they do the reinvestment process of like as the treasuries on the Fed balance sheet mature, they reinvest it, but they make sure to reinvest it into longer term maturities. So naturally you end up with more duration on the Fed balance sheet. And then at the same time, the balance sheet has been going down, but it's been going down mostly from bills. It's low, like short duration assets you can see on the right side. So putting that all together, Andy Constant actually did this analysis a few months ago, and effectively over the next few years, if they want that duration to match, the open market will need to digest like $1.4 trillion of duration. Now they can extend that. Like this can be a decade long process, but there's two key considerations here. One recession or one crisis, and this script will get flipped overnight. Like they will not be able to just stand still and watch the world implode. even just because they have this idea of they want that their balance sheet durations to match. But the fact is that we've been seeing them become the marginal holder of that duration, and they don't want to continue that. So directionally, that's where they're headed. So to me, it's like the focus on Main Street versus Wall Street is to lower the Fed funds rate, so get floating rate debt to cost less for those smaller businesses. Whereas at the long end, they want that to steepen. They want basically a bull steepener in the yield curve. I think they want to steepen that yield curve and make it so that the debt on the long end, which is how these big mega caps get funded, that'll be more expensive, but it's cheaper for the small businesses. So there's a lot of these different cross currencies, and I haven't fully learned how all nets out, but I think directionally, like, this is going to be the playbook, and I think it's quite different from what a lot of people are expecting, which is they're expecting QE to start like tomorrow.
The funny thing about it is exactly what you point out, is that it's such a pipe dream, because, okay, let's say that's 1.4 trillion to balance. If they do 100 billion a year, that's 14 years. If they do, let's say, a very high number, let's say they do 300 billion a year, would be like 4.5-5 years. And even that 300 a year, that's like, that's a sizable amount per month of duration entering a market that's already supporting itself by more and more levered hedge fund repo trades. And you think about these numbers, you're like, okay, what are the odds that in the next 10 years, we have an event that requires emergency balance sheet response? Like,
pretty high.
Yeah, like 90%. I don't know. Like, considering they did emergency balance sheet response in 23, they've done it. It's just, so it's just interesting, man. But they do need to do this to even out the playing field, because they need the yield curve needs to be steepened to remove the benefit, the inappropriate favoring happening to long end versus short end. That needs to happen. It's just a matter of like, what rate else does it done it? Yeah, exactly.
Yeah. If you're thinking about buying crypto but don't want the headache of setting up wallets or new accounts, Grayscale makes it simple. For over 10 years, Grayscale has helped investors gain secure, regulated exposure to crypto without the hassle of self-custody or opening new wallets. With over 30 investment products, from Bitcoin and Ethereum to diversified and thematic crypto baskets, Grayscale makes it easy to build a crypto allocation that fits your portfolio. Whether you're using a regular brokerage account or investing through an IRA, many of Grayscale's products are available right where you already invest. Investing involves risk, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. I saw you have some charts on currencies right now. I'm curious, what do you got going on there?
Well, yeah, there was one I was just trying to pull up, which is like China trade balance, is dropping because of the tariffs, and essentially that's less money. I mean, they're not really buying our treasuries anyway, but that's usually when that trade balance gets all messed up. You get wonky FX stuff. So we'll go through a couple FX things. One is 52. This is Japanese government yields, 10-year government yields. And that's just breaking out. You can see the shorter term chart is on the left, the super long term chart's on the right. And they're doing 100 billion in stimulus. This isn't necessarily, Capital Flows talked about this a little bit. He does awesome stuff, by the way. But he was
on the show this week. I don't know if you saw that.
I know, it's on my list.
Great guy. Yeah, good. Check it out. Yeah,
he's the man. Highly worth the subscription. So he was basically saying, the carry trade unwind is not necessarily a concern because this is happening slowly over time, yada, yada, yada. But, and then I wanted to go, let's see, if you go to slide 56, there's lots of this is what's making me a little bit nervous. This is the Chinese yuan versus the yen. And so the yen's getting a lot weaker. It's at if you look at the chart on the right on this one, if this really breaks down, something, it's a new level for the past 20 years that we're going to, where it's really putting China in a precarious place because the yen's getting a lot weaker. And then you can see it in, what happened to the dollar on slide 57. Yeah. So basically, everyone was obviously super bearish on the dollar, and it shoots right up, and now it's kind of moving, causing a lot of cross currency volatility. And then if you look at slide 58, you can see the yen kind of really weakening here too, and similar chart to the onshore yuan or offshore yuan, which is the second chart is kind of showing like if we break through that 160 level, we're in like a macro whole new world here, where if that breaks, the dollar goes up. That could cause like the dollar wrecking ball type scenario. That's just something to keep on your radar, because like when you get a lot of FX volatility, then it follows through to like cross, bond volatility, which follows to the equity volatility. So I'm a little bit, even though NVIDIA came out, they're trading up 5%, but there's a lot of weird stuff going on where they reverse lower and it's all fine, but
I think what's weird on that yen point is, if it's so funny, anytime there's just volatility in the yen market, people are like, yen carry trade online, but it's like, no, it's actually like the yen is weakening. It's mostly just a story of the new prime minister that they elected, who's like super dovish. They want to unleash a lot of fiscal spending at a time where inflation's above target. Of course the currency is going to weaken. Of course long end JGBs are going to sell off, but that's not like my understanding of the yen carry trade unwind is a yen weakening is the opposite, is it not?
Yeah, well, that's why the Nikkei just keeps. I mean, it was kind of grinding up here, even though yields were kind of going higher. So, and generally, I think Capital Flows talks about this. Usually, the carry trade unwind comes when people buy JGBs and the yields go down. That's what happened in the previous, unwind. So.
But yields don't really go down because they're shit. So it's like, it's more they have to defend the currency and they have to sell US assets to do so, is like the idea behind.
Yeah. We need to get out, like, right? We're getting to that 160 level where they have done the interventions before. Maybe that could happen afterwards. But right now, the direction we're going in is like, it's actually probably positive for that carry. It's just the ensuing intervention that could occur obviously would not be great. And that's always the dance, right? Of if you're trading yen, is that the Ministry of Finance is going to be like on the other side of your trade if it gets bad enough. And that's just they call it a widowmaker trade for a reason.
Well, they're just so far advanced, so much further advanced in their problems than the rest of the world. So like we will be talking about these yen weakening to strengthening cycles for the next 5 years, because it's all bullshit. It's a controlled burn. There is no solution, like there's no logical or like smooth functioning thing they could possibly do to correct this, other than destroy real returns to their investors over a long period of time. So they're going to, like, we basically have this big range, which is 140 to 160, and Bessent and their finance people will just continue to play this game of like, okay, when things get bad enough there, they will have to sell US assets, sell dollars to buy yen. That's bad for US risk. Then that means that, we'll have to step in. That people like, that's why I don't think the 4-year cycle shit for cryptos, like Bitcoin, we're right at. Anyways, I'm diverging, but
we'll get into that for a sec. But yeah, it's interesting. You said that 140 to 160 range, we should call that like the cabal range, because at 140 you have it that's when the carry trade unwinds, so they got to intervene there. And then if you get to 160, that's where the Ministry of Finance intervenes. So you just have this cabal range,
Yeah.
The more interesting chart is gold and yen. That's the most interesting. Is just gold and gold and these other currencies, because that thing, like, that's. Maybe that's the next step, is they restrict their citizens from being able to buy gold, because that thing is like the most bullish chart in the history of like anything.
I think we're watching the Western world just got way too centralized, central banking, and that it's got to be a managed burn here, where we have to interact with all of our allied partners to do this slowly, because otherwise it just blows up. The last chart I'll stop after this, but check out, this is slide 54. I was kind of shocked at this. So this is the carry trade for LATAM currencies. So this basket is a buy and hold carry trade that is long 6 Latin American currencies: Argentinian peso, Brazilian real, or real, as Americans call it, Chilean peso, Colombian peso, Mexican peso, and Peruvian sol. It's fully funded with short positions on the US dollar. So money's seeping out of the US, into these. And this is why probably Venezuela is a big deal to Trump, is we're rewriting a lot of global macro and trade partners into different parts of the world now. And South America is a big piece of that. They have a lot of natural resources. We need to have a presence there if our relationship with China is fading. So this is something to keep on your radar as well. But yeah, a lot of crazy macro things happening right now.
I feel like that's why, like, there's just, people are falling over themselves to obsess over, I don't know, the TGA and like the Fed balance sheet stuff, when I think there's so much more interesting things going on. Like these FX pairs that you just walked through, like this is the big game at hand. And it's the big game at hand contrasted against, the tariff stick on one side, and then on China, the rare earth thing on the other, and just trying to net out, like, where's this whole world, this new world order going to land us? Like that has 1,000 times more impact on where macro is going.
Yeah. Hopefully we're capturing a little bit of that. It's a giant game of risk, and we're trying to play the game the best we can and not land on, giant landmines. But this is definitely more precarious than any time I've seen it in the past couple of years in terms of Fed expectations, the gap between boomers. I do want to roast boomers again at some point, but we can get into that maybe later.
Yeah. Quinn, do you want to do a little state of the crypto market? I know you got some slides.
Yeah, hit slide 28. I was kind of refreshing on some metrics that I thought I'd share. It's pretty interesting. So for all the carnage and despair, which, Bitcoin obviously outperforms when beta goes down the rest of the market usually, but we're right at the normal drawdown of this cycle. So there's been we obviously had in 2024, the peak to trough was about 30%. And then in earlier this year, there's 30%. And we're just getting to that 30% level. So this doesn't mean we have to bottom here, but it's so far been not that different from things over the last few years. If you go to the next slide, this is the net unrealized profit loss, NUPL, and Bitcoin. So basically, like, how much profit unrealized is our holders sitting on, and it's the lowest of the cycle. It's the lowest since late 2023, meaning it's kind of a factor of both whales, long-term holders selling, as well as near-term holders who are in the black. So it's low. It's I mean, again, in bear markets, it can go lower, but it's an interesting data point. The next one, I thought this was super interesting. This is the rolling 7-day moving average of short-term holder realized losses. It says 3-day, but it's 7. This is at levels last seen in FTX crash. So I put this chart back 3 years, and this is extreme short-term holder capitulation. There's effectively no profits left in this short-term holder cohort, and that's anything from there's different definitions, but you can go from kind of 0 to 6 months. And that just shows the level of capitulation, meaning all these people recognizing losses in selling. And then on the next chart, so you think that's one cohort of market participants. On the next chart, this is the long-term holder spending indicator. And this shows, so you see these orange blocks that show when long-term holder spending is very high, and it's usually around huge runs. So after Trump's election victory, after the ETF launch, and then this summer as well, there's some large areas, and normally it's into price, it's into trending price, higher trending prices. around the ETF was one you can see in Jan 2024 where they actually were capitulating the lows really good. And actually in April, February, kind of Q1 of this year, they were capitulating lows. But other than that, it's generally around tops, and that's very high. So you've had, over the last 6 months, you've had basically some of the highest consistent long-term holders selling. And the next chart kind of shows that in a more cumulative type of format, which is the spent volume and profit from 6-month holders to 3 years. And what you'll see is we basically just slow and steady increased this realized profit for the 6-month to 3-year holder group. And those previous spikes occurred, like I said, into huge price appreciation, like around the election and ETF. And historically too, I put this chart even further back, it is into price spikes, not into price declines. And so you sort of have to wonder here why this behavioral change is occurring. Why is it that long-term holders have decided to liquidate so heavily into not great price action? So you could make the argument that it's only time will tell, but you could make the argument that it's capitulatory in some sense. You can make the argument that it's the 4-year cycle belief. You could make the argument that they're scared of quantum risk. Whatever it is, it's a condition. It doesn't necessarily mean something. So kind of short-term, long-term holders. The next chart I was showing is the IBIT ETF flows in Bitcoin terms. So it shows that since existence, this is the 10-day moving average of flows. Basically, the net outflows have basically on a 10-day moving average, as well as 5-day, basically surpassed the Q1 sell-off. So we're getting to, it obviously can go lower, but we're getting to very serious capitulatory levels from the ETF holders as well. And the next slide, it shows ETHA, which is drastically the largest kind of net outflow in its existence. Next slide was just the vol profile, implied vols of corn, which I found interesting actually, because everybody kind of believes as the asset matures that this dampening volatility profile is going to continue, but it seems to sort of bottom out in this like 30 to 40% area as it did in 2023 as well. And if you think about it, like, gold kind of moves between 15 and 30%. And that's a thousands of year old, much more liquid asset than Bitcoin. So it would appear to me that we've sort of found a bottom of steady state Bitcoin vol in the like 30 to 40 range. And I think that makes sense, but we've come up on the sell-off here. So it's elevated. And then the next one is just skew. So we're at very elevated and have been for some time, put skew. So basically option demand favors downside protection, at a sizable difference, which is usually, it's a condition you like to see around bottoms, but it's been this way for some time now. And then just the last two is dominance, open interest dominance by Bitcoin versus alts. And it's very elevated, for Bitcoin, which, just means a lot more concentration there and kind of Bitcoin dominance measure. And then the last one is the altcoin liquidations over the last 2 years, which is, there's 10-10 and everything. So I just think it's a unique spot because, on the one hand, you have this very quantifiably large liquidation selling. And I can't remember a time. I mean, there's a number of good arguments for why it is. But I find it interesting because the most probably behavioral thing that I see is people just thinking 4-year cycle, it's over type of deal. But when you compare that to this cycle, it hasn't traded like traditional crypto cycles at all. So I don't know why it would start now. And it kind of goes back to what we're saying about these managed periods of liquidity and treasury issuance and the Fed facilities and all these things. So unless you believe that one, crypto is doomed due to like a quantum risk, or we won't need Fed intervention ever again, then I guess it's proper to believe it's over. But it strikes me as like pretty interesting area to do business.
Yeah, I just find it's so hard to navigate this point, because it, like a lot of what you just said, a lot of those things are quite idiosyncratic, but then you contrast it with, I think another one too is also the DATs. Like we're in an overhang period now. Like I talked about a couple months ago, saying I was explaining this my framework of thinking, which is that there's this pocket of premium baked into crypto price because of the DATs, and we need to compress that pocket before there's value again. And now we're undergoing that process. Like every DAT's at a discount. We're realizing the whole thing was I don't know, I'll try to be nice about it, but it was a mistake. And so you need to rectify that. So it's these idiosyncratic things, but then you look at the trajectory for the next year or so, like, and then you pair that also with just this weird kind of short-term pivot in the Fed reaction function too for December. So it's like these short-term things, but then you look at what's happening and what's going to happen in 2026, and it's like, I still want to own Bitcoin. Like it's going to be the best asset to own for that period, and it's just trying to navigate these spots. And when does those idiosyncratic moments end, and it's frustrating.
It kind of, on the treasury company thing is, sometimes the best way to own it is just selling puts. Like why do some of these guys, I mean, maybe some of them are over levered, I don't know, which is why we've seen this cascade of selling at spot. But right now, I saw like MicroStrategy's, I'm not involved, but like their average price was like 102 on their spot.
Yeah.
And I just, the best way to execute right now is, why wouldn't you just sell puts? You take in a bunch of yield. If it goes to your level, then you get that spot, you get that Bitcoin, I don't know, 5-10% below spot price. And if not,
that's what Dan Lee was doing on Ethereum, which I think was kind of interesting. Like, I think he was trying to do that. And I mean, I don't know, maybe just,
of course, because Steele's involved there. This is the best way. But you have to think about like the trade and what's the best way to enter it. And if you already have God knows how much Bitcoin, like mine, why wouldn't you do that? Lower the vol, indicate there's a buyer there at a lower, I don't know. It's just me strategically thinking about it.
You know what I think it is? I think he realizes how little ammo he has in the chamber. Like the only reason he bought that was, this is just looking at a STRC. So it's the quote unquote money market, digital money market fund. So like very low duration preferreds that. And so the idea was to launch it at a discount to find the equilibrium rate. But once it got to par is when he was able to unload that. And so I think there's this bit of panic, which was just like, okay, we have the chance now, fire that clip. But man, the reaction ever since has been pretty brutal. Like, this is, if this is a digital money market fund, it's not great to see that trade from $100 down to 90, like instantly. That is, that's,
what? When you really step back and think about how geopolitically destabilizing, if Bitcoin actually worked, what structures are in place, you can see a state actor going after, if they see the vulnerability of treasury companies, they're levered, and actually like attacking that, shorting those companies, creating like a liquidation cascade. Because if you think about like China, they want a gold-backed yuan. They're replacing their treasuries with gold. Like maybe we crossed the Rubicon where it's like that's been on my mind for months now, where as soon as you go from global or just like fun frontier asset to global reserve collateral, that actually threatens a lot bigger things, political structures, countries, and countries will do whatever they can to stay alive. And so I don't know. That's probably a little more on the conspiracy theory side, but it is disconnecting from gold. So
we're in the like first inning of this this, if you want to talk the geopolitical angle, one of the things I think is most important is stable coins are like a vampire, to use crypto terms, a vampire attack on foreign currencies, because they're basically saying, hey, are you a citizen of an emerging, developed, or floundering developed country like Europe or somewhere else that are sick of slow growth, open border, all these different policies? Well, you can ditch your currency and come to the US dollars in a way you've never been able to do before. And I'm not advocating that's, I mean, I'm an advocate for other assets over any fiat, but just looking at currency charts, the dollar has generally outperformed the vast majority, and over a longer period of time. And so stablecoins are a way to basically extract as much marginal capital from these other jurisdictions that you couldn't access before. And the crazy thing is that, to be openly talking about this in this manner is incredible, because it's basic. Like when Moran talks about it and Bessent talk about it, that they explain it in this exact manner. And what they're not saying is like, they're admitting to like the KYC aspect, the the financing of things they can't track. Like, okay, you could track stablecoins way better than you can track dollars, but like they're basically advocating for the open, permissionless proliferation of dollars globally, which from a like national security compliance particular perspective would have never been like something you'd hear from politicians. In reality, it shows they understand it, because your surveillance is much greater with stable coins than with cash. But
your cost of capital goes down as a country.
For sure. I mean, it's just funny because you never used to hearing politicians or regulators talk in a logical way. And that is one of the things that's logical. Anyways, to wrap it up, like we're in the first inning of that. And that's going to continue to increase the more Japanese yen situations you have or what have you. And, countries are going to try and put capital controls on it. And China has done that. And many others will do the same.
We're seeing it another, like Bank of England made it so that you could only own $20,000 of stable coins. Like this isn't conspiracy theory. It's clear. Like you have the US saying, like, I think we all agree dollar dominance is going to increase because of stable coins. And then you can see the reaction. Like Bank of England is saying, as an individual, you can't own more than $20,000 of stable coins. And that's because they're scared of losing control of monetary policy in their country.
Yeah. And so when you put it in that sense, you're like, okay, well, the first step is stable coins, because you're like, wow, I can own dollars. And then you're like, wait, dollars suck too. Okay, what else do I own? And it's the same way why these populist and political cycles take so bleeding ice cube glacier to play out, because the boomers getting out of office, no policy they can do will get them out of office. It's no matter how bad, how unfair, how ridiculous, whatever. The only thing that's going to get them out of office is younger demographics coming into control of the voting blocks. And so it takes an enormous amount of time, but it's going to happen. And so that's just my point around this, is that like in the same way that, we can see the Midmanis and all these guys coming to power, but it's so slow. But it's so slow, but it's coming, and it doesn't change. The trend is there, and it's impossible. The younger cohorts coming of age, and that's going to be the same with stablecoins and Bitcoin.
You know what? On the Mamdani, you're going to say you're going to have me say it wrong. I got some interesting feedback last week after the episode, which is, I love getting that stuff because there's a lot of smart people out there. And because I framed it as Mamdani versus Nick Fuentes as like the political extremes. And one guy actually had a pretty good point. He's just like, Mamdani is not saying like crazy racist stuff. He's actually he framed it as, and this is the framing of like the left, is this could be like a New Deal type situation where they're rewriting, the social contract for labor. And that's a fair point. And I, in that respect, I don't think that's gonna, I've lived in New York my whole life and it's already become a complete shithole. Excuse my French. And so like you're gonna take more money away and reallocate it. Like I don't think it's gonna work personally, and it's only gonna get, I think it's gonna get worse because that's just you the infrastructure just keeps decaying. Like you made it's a crazy place. But my point being is that like I don't know, maybe it does work, and I can do a mea culpa here in 6 months, a year on the billionaires tax. But personally, one chart I wanted to actually show was this. It was the Austin, Texas. The number of
population
children
change, yeah,
under 5 years old, and what it shows is all these cities that have just been broken down, poorly run, terrible governance, that basically have no capacity to reindustrialize their infrastructure, and they just keep taxing. New York's tax is at I think it's like 57% effective tax, and if you just look at Texas, you keep all your paychecks, zero income tax, and the state has a $30 billion budget surplus. That's why there's kids here. That's why there's kids under 5, and the population growth is skyrocketing. So you need to break down all the barriers and actually reinstitute capitalism and not the corporatism that's been in New York and San Francisco. That's where I'm at. But I'm open to the fact that if this is a productivity boom, AI works, UBI and Mamdani does it, and it's great. One of the other points they made was, if you look at a lot of the Norwegian countries, socialism works there. And I'd argue that it used to work there, but it's just there's too many people, too many incentives than a very, homogeneous, there is just a cluster of different incentives where you're never going to please anybody. So I don't know, that's just kind of where I'm at.
That's a very fair self-reflection. I appreciate that.
But it's, I love this feedback. It makes for way better conversations, because it was fair. He's like, Mamdani, I've never seen Mamdani, go on racist rants, and it's to pose those two guys in similar light. That's kind of a fair point. But I think I'm on a slippery slope. History says socialism and communism are on a slippery slope. So that's where I don't know, history doesn't have has a better track record, I guess.
I think the point is that the general is that no one really has a solution. No one, this cohort of people who are upset with the status quo, that's the first and foremost thing, is that they're upset with the status quo, not that it's much more difficult to have actual solutions. And I know, the light bulb. So these are all just versions. Some people, might become more racist. Some people might become more socialist. Some people, the moral of the story is none of these things are great for society, but it's everybody. It's more destructive mentality, because it's I don't know what the answer is, but it ain't this. And so I will latch on to whatever kind of worldview clicks for me more. And it's going to take many different flavors, but that's where things now, as we mentioned, are evolving into a class versus class system versus a red versus blue system. Because
regardless, the direction is a fracturing and fragmentation of the world. That's what we know is happening. And I think that's where it's tough to see, but in the same vein, I get it. Why would you vote for Cuomo again when you still can barely afford rent and groceries? I totally get it. It's just tough from a high level view, for sure.
Can you show the last, not to belabor this, but show chart 4, and I kind of rant against boomers a lot, and they're like, well, work harder, and I'm like, well, you kind of bailed out the fact that you printed $15 trillion for the past God knows how many years. Sorry, my printer's going on in the background here. My bad. So,
you are old. Do you have a printer still?
Yeah, sorry. What I wanted to say was, I wrote this thing, which is this should be kind of a bipartisan, how to solve it is get rid of red tape, like tax incentivize having children. Try to create incentives for labor in the workforce where it's not just, the CEO has a $10 gazillion bonus. Like, you have to figure out a better way on the corporate America side to actually rewrite the social contract. We're not talking about any of this stuff. It's either like, I'm going to take, your pie and eat it, rather than like incentivize the growth of the pie. I think there's parts of that being talked about, but it's not like cut the red tape. It used to be, you can't compete with BlackRock in Vanguard. They have in industrial type scale, but now they're perverting capital markets. It's not doing great. Break them apart. Like, create different, you make rules so that but you can't, like, all these things are too big. So it's really hard, but I would love to see a politician go out there and actually do some of this stuff. Make it so like, hey, let's have kids get out of student loans and make a policy for that so that they can actually own a house and they keep the system intact, capitalism intact, instead of, devolving. And so I think, I don't know, these are the ideas that people should be actually talking about, but they just talk about the stuff. It's never when or the why. It's, how it's happening.
Good stuff.
Yeah, man. Cool, guys. Well, hope you have a good weekend. Good chatting, and see you for the next one. Always a pleasure.
Thanksgiving week next week, so everybody got to do a fast this week.
Yeah, there you go. Get ready.
Take care, guys.
All right, see you.